1300, most people have no idea what's about to unfold in the silver market. If I tell you outright, it'll sound unbelievable, almost absurd, but stay with me, because this isn't speculation or hype. It's the logical conclusion of a setup that's been building for decades. A fifth and final stage is forming, a stage so powerful that the chaos of 1980 will look like a warm-up drill. Analysts aren't talking about it. Fund managers aren't discussing it. Even veterans who lived through the Hunt brothers mania have no clue how different this time truly is. And the wild part, we've already gone through the first 4 stages. They're finished. Complete. Done. Right now, in late 2025, we are standing in the narrow space between Stage 4 and Stage 5, the quiet before the detonation. And if you don't understand the path we took to get here, the final stage will seem impossible. So let's walk through it step by step, because once you see the pattern, you'll understand exactly why Stage 5 cannot be stopped. Stage 1, the forgotten metal. The first stage began in the late 90s, a period when silver was so unloved it was practically invisible. In 1999, an ounce of silver traded for about $5, literally cheaper than a fast food meal. The entire precious metal sector was dying. Mining companies were going bust. Analysts called gold relic, and silver was treated like a joke. But beneath the surface, a shift began. After years of unloading gold, central banks abruptly stopped selling. The Bank of England had just dumped half its reserves at $275 an ounce, what became known as the worst trade in financial history. That was the bottom signal nobody recognized. Quietly, silver started inching upward at 6 through 7 at 8. No headlines, no excitement, but the smart capital was accumulating. By the early 2000s, silver had climbed to around $550, still dirt cheap, still ignored. But the groundwork for a massive multi-decade setup was laid. Stage 2, the crisis response. The second stage arrived with the 2008 financial meltdown. When Lehman collapsed and the entire banking system buckled, the Federal Reserve unleashed something the world had never seen: trillions of dollars printed out of thin air to hold the financial system together. And silver reacted instantly. From about $9 in late 2008, it skyrocketed to nearly $50 by 2011, a 5-fold explosion in less than 3 years. Predictably, the mainstream said it was a bubble. They said silver was overheated, that it would crash, that it was just another 1980 replay. And yes, the price did fall. By 2015, silver had collapsed back to the mid-teens, and everyone who bought near the top got crushed. What the commentators missed is that Stage 2 wasn't about price. It was about proving a permanent rule of modern markets. When central banks print massive amounts of money, hard assets respond violently, and no metal reacts faster than silver. Stage 3, the retail awakening. Stage 3 erupted during the 2020 global shutdown. The world froze, but central banks didn't. They printed money on a scale that dwarfed 2008. In 2 years, over $18 trillion flooded the global system. The Federal Reserve alone added more money than it had created in the entire decade after the housing crash. Silver exploded from around $12 in March 2020 to nearly $30 within 5 months. But this time something new entered the picture, something the silver market had never experienced before: mass retail coordination. Groups on Reddit and social media that had just shaken Wall Street with the GameStop saga suddenly turned their attention toward silver. They bought physical metal. They bought ETFs. They wiped dealer inventories clean. Premiums spiked over $10 per ounce. Some paid $40 for silver that Spot said was trading at $28. This wasn't just a price movement. It was a proof of concept. It showed that ordinary people, acting collectively, could disrupt a market long dominated by paper contracts. By 2022, the price retraced back to the high teens, and critics once again declared silver dead. But they misunderstood what Stage 3 had really revealed. For the first time in history, retail investors demonstrated they had enough firepower to fracture the paper-based pricing system. Stage 4, the supply crunch. Stage 4 is the stage we're living through right now, and it's the most important one because it cannot be engineered away, papered over, or legislated out of existence. Global silver mining peaked in 2016 at around 900 million ounces. Today, we're down to roughly 80-30 million annually, a steady decline. Why? Because most silver isn't mined directly. It's a byproduct of copper, zinc, and lead mining. When those markets slow, silver supply shrinks. Meanwhile, demand is exploding at a rate never seen before. Solar panels devour silver. Electric vehicles require silver in their electrical systems. The 5G networks rely heavily on silver. Every major electronic sector depends on silver. Medical tech, water purification, and renewable energy all consume more every year. Industrial demand alone is burning through 600 million ounces annually and rising. Then add investment demand. ETFs collectively hold about 700 million ounces, metal that is locked away and not available for industry. India and China are importing record levels. Above, ground inventories are shrinking. The COMEX deliverable supply has fallen to about 250 million ounces, enough to satisfy global industrial demand for just a few months. Stage 4 is the tightening no one can ignore. The walls are closing in. And that leads us straight into the stage nobody is prepared for. Stage 5, the breakpoint. To understand the final stage, you need to forget the old comparison to the Hunt brothers. Their squeeze was centralized, leveraged, and vulnerable. When regulators changed the rules, the entire structure collapsed. Today, none of those dynamics exist. Stage 5 won't be two billionaires cornering the market. It will be the millions of retail investors, the industrial giants desperate for metal, the institutional funds shifting allocations, one ETFs absorbing physical inventory, the governments scrambling for hard assets. And all of this happening while global inventories are near historic lows. In 1980, governments had mountains of silver. The U.S. strategic stockpile alone held billions of ounces. Today, those stockpiles are gone. China has flipped from exporter to heavy importer. India's silver is locked in jewelry that will never be recycled at scale. Above ground supply is razor thin. In 1980, industrial demand was small. Photography could be substituted. Electronics used minimal silver. Today, there is no replacement for silver in critical industries. In 1980, there were 0 ETFs. Today, ETFs hold more metal than entire nations. In 1980, the price collapsed because the Hunts were forced out. In stage 5, no single group controls the market, which means it cannot be shut down by changing one rule. Stage 5 begins when the physical market finally breaks the paper illusion. When the futures market can no longer deliver metal at its stated price. When the spread between paper silver and real silver becomes too wide to ignore. We've already seen glimpses of this. In 2020, 2021, physical silver traded at premiums 30–40% above spot. That happened in a market that still had inventories to draw from. In stage 5, those inventories won't exist. And once the physical premium becomes permanent, the old pricing system collapses. COMEX can't print silver. Governments can't legislate new supply. Industrial users can't simply switch materials. At that point, the market enters a frenzy. The manufacturers begin hoarding 6 to 12 months of supply. The retail demand surges worldwide. ETFs struggle to source metal. The inventories evaporate. The premiums explode. While the paper market loses credibility. Prices could overshoot dramatically, 100, 200, perhaps beyond, before finally settling at a new baseline far above anything we've seen. Because unlike 1980, the shortage won't vanish after the spike. The fundamentals remain broken. Production won't magically jump. Industrial demand won't shrink. ETF holdings won't return to market. Stage 5 resets the silver market permanently. Everything leading up to today has set the stage for the final break. The deficits, the declining supply, the accelerating industrial needs, the ETF absorption, the shrinking inventories, the global shift toward real assets. Stage 5 is not theoretical. It's the inevitable result of basic arithmetic. The only unknown is timing, but once the spark hits, the reaction will be explosive and unstoppable. The question is simple. Will you be positioned before stage 5 begins? Or will you be trying to buy silver when the world suddenly realizes there isn't enough left?